What's going on, guys? It's Ricky with TechBot Solutions. So thank you guys again for joining us for another helpful video. If you guys don't know anything about TechBot Solutions or this YouTube channel, we do upload a daily recap every morning around 12:30 Mountain Standard Time, and again, that is PM. And then a helpful video Monday through Friday at 5:30 Mountain Standard Time. So for today's helpful video, we're going to be talking about why is it important to understand averaging down and averaging up, and what are the importance of it, right? It is a very common question since I've talked about averaging up and averaging down before within the group chat. And for those that aren't familiar in a sense with that term or with the language that we use when it comes to trading, pretty much averaging down, for example, it's like, let's say you buy hypothetically Apple at $100. You buy Apple and it's in a downward trend. It's now at $95, $90. You continue to buy shares to make the overall amount that you've lost to seem less, right? Or to, in a sense, you put more money into a stock. So let's say you put $1,000 at the $100, so you have 10 shares. Then when it gets to $95, you buy 10 more shares. So then your average is about $97 per share. And as it continues to drop, you buy more. So the overall average of price that you've bought in at continues to get lower. But is that a good thing? So when it comes to trading penny stocks, especially, not talking about Fortune 500 companies, but penny stocks, usually stocks valued at less than $1, looking at the overall analysis, performing a technical analysis on the company and seeing on how it's played out within the past month, within the past year, and seeing if it's in a consistent downward trend and you're planning to hold overnight, is it smart to average down? Well, no. And the reason I say that, again, this is just my opinion. In no way do I want you guys to, in a sense, replicate anything that I'm talking about. This is just talking to you guys about what I think and what's led to my success when it comes to trading. I did watch a couple of videos about other people's experiences when averaging up and averaging down, and I've gotten a lot of feedback with other people within the group averaging up and averaging down and what works out the best. So think about this, the best way for me to put it for you. If you are investing in a company and it sees a consistent downward trend, and what you think of a company, what you expect it to do, as in, go up in value, but it continues to average down, you continue to lose money, right? But the amount of money that you lose isn't as much because your average continues to, in a sense, reduce as you continue to average down. Is that a smart thing for an investor to do, especially a day trader? I wouldn't say so. The reason why is because if you're a day trader, you should understand support, resistance, and where to cut losses. Averaging down is a technique that you can use, but in the long run, averaging down is not necessarily going to be a technique that's going to be very useful or beneficial in the long run. And the reason why is because a lot of these penny stocks see a downward trend and never come up to see the light of day. And what I mean by that is I'd hate for you guys to invest money into a company that you believe will continue, again, letting your emotions come into play, and believe that this company is going to, see an upward trend when it's consistently seen a downward trend and you continue to average down. So not only have you thrown more money into a stock that continues to decrease in value, but now you've broken the rule of cutting losses, you've broken the rule of letting your emotions come into play, and now you're losing money, so now you're going to get discouraged. So what I would say has led to my success when it comes to trading is, first of all, emotions are definitely not something that you want to have into play when it comes to investing. Now, especially when it comes to averaging down, you always want to make sure that if you do feel like you have to average down, or it is going to be a useful resource to average down, then you need to make sure that you understand where you're going to cut your losses. If you bought in at $10 per share for whatever company it is, you should understand where your support is, and if it falls below that support, usually you should cut losses then. But if you don't, let's say cutting losses, what I do is cut losses anything lower than 2.5%. If it goes anything more, if I lose anything more than 2.5%, I cut my losses right away. And this comes with also averaging down. So from your initial purchase price of buying at $10 per share, you should say that once I lose 2.5% of whatever that value is of the $10 per share, I'm going to cut my losses. So let's say I cut my losses at $9.75. That's where I'm going to have my stop loss at. I can continue averaging down if I feel that it's going to really go up. But again, that's not necessarily something that I would recommend. But as it continues to go down, and it goes below that 2.5%, you should have your stop loss set to just, no matter what the scenario is, no matter what you believe in, it will cut your losses and it will, in a sense, only allow you to risk 2.5% of your initial purchase price, meaning that at least you can manage and control the amount of money that you lost. The only reason you're averaging down is to get a better, in a sense, average price, to see when, if it actually does end up going up, you have more margin of profit, right? And that's pretty much for averaging down. So you can use that as a technique to, in a sense, reduce your initial purchase price to a lower dollar value. But what would be the smartest thing to do? Is it smarter to throw more money into a penny stock or into a stock whatsoever as it continues to staircase down? Or is it a smarter thing to do to invest money and average up when you see an increase in price? If you see a lot of penny stock investors, or a lot of investors in multiple markets, not just the stock market, but in like buying real estate, Warren Buffett says that he buys homes when he sees the increase in value, when he sees the property values in the homes that he's buying increase, and he buys and he averages up, right? He continues to buy as the economy gets or grows. And you can implement this same technique when it comes to day trading. If you're investing in a penny stock, you're investing in a Fortune 500 company, if you can continue to buy and average up, meaning that your initial dollar value, yes, it is getting higher, right? Let's say you bought it at $1, now you're buying at $1.50, now you're buying at $2, but overall the amount that you have invested in this initial stock that's seen an upward trend, yes, you are seeing a lower dollar value return, but when it really comes down to the overall amount that you have invested, let's say you invest initially $1,000 at $1, and then $500 at $1.50, and then you invest another $500 at $2, but it continues to increase in value. The return that you're gonna see is so much greater because of the buying power that you have in that initial stock. So instead of averaging down and hoping for the best and hoping for it to come out of water, right, and see the light of day, I really would suggest that you understand what it is that you're investing in. If you're investing in a penny stock and you see that it's consistently been on a downward trend, don't let your emotions get into play. Set up a plan. Set up a plan where you're buying, where you're selling, where you're gonna cut your losses. And then if you decide to average down, that's fine if that's what you identify as potential. But understand that stop loss should be something that you should stick to minimize your overall loss and control the amount of money that you lose within your overall account. Now, when averaging up, it's something that I've done when trading JDST, JNUG, as it continues to increase in price, and those are ETFs. As it continues to increase in price, I continue to buy because I understand the resistance where it's at. Let's say for JDST, the resistance being at $14. If I bought in at $12.80, I will continue to buy as the price increases. So at the end, when I sell at $14, my overall buying power for that company is 4 times of what I initially bought at, but I bought on an upward trend, meaning that I understood that I was buying a good, in a sense, or I was investing in a good ETF or a good stock, right? And that's the whole point. Why invest in a stock that's seen a downward trend and continue to throw money at it to hope for the best, to hope to see a return or to break even? Why not just cut your losses and move into a stock that's seen a consistent upward trend and invest in that, and continue to continue throwing money into it as it continues to see an upward trend? And then again, stick to your rules, support, resistance, cut your losses. You can follow with the trailing stop loss as it continues to rise, and then sell with a limit order at whatever the resistance or your in a sense ideal sell point is. And that's really just it. I just wanted to give you guys a better breakdown on what to expect when averaging down and averaging up, in my own opinion. Again, this is not a suggestion for what you should do, but what I would say is what's led to my success when it comes to averaging down and averaging up. I've seen more failure when it comes to averaging down than I have when it comes to averaging up. It's always just ideal, although it might be very uncomfortable, and you're hoping for the best, and sometimes that you sell, you see a rise. Overall, in the long run, when it comes to being successful, when it comes to trading or investing, you want to make sure that you have a stop loss where you cut your losses, and then you move into a stock that has an upward trend. And I think implementing that into a strategy or technique when it comes to trading is definitely going to be something that's going to lead a lot of investors to be successful. And that's really just it. Thank you guys again so much for watching. If you have any questions or suggestions for these helpful videos that we upload weekly, then feel free to let me know in the comments. If you guys found this video helpful or would like me to elaborate a little bit more on this specific topic, feel free to let me know. And then if you guys can, give this video a thumbs up if you guys found it helpful. We are nearly at 9,000 subscribers, so I'd love to be a part of your success. success. And if you guys can subscribe, we'd greatly appreciate it. If you guys want to be a part of TechBot Solutions, we're sitting a little bit over 12,200 members worldwide. And again, it's a wide band of individuals from beginners to experience. And the thing that we do best is sharing best practices and sharing mistakes in an effort to promote growth. I can't thank you guys enough for the support. And like always, let's make sure that we end the year on a green note. Take care, guys.